Fintech stocks are plunging. You look at Upstart down around 60% following their first quarter 2022 earnings update. You look at SOFI falling in tandem down around 20%. The stock is halted at the time of this video publication as a result of their earnings being published ahead of schedule. And the crazy ride that Upstart has been on is just sort of mind-blowing. You see that since it went public, it at one point was up over 1,000%, effectively giving back all those gains to speculators, and this has just been an absolute crazy run that you've seen, and investors are wondering, like, is this the end? Why are these stocks collapsing? What is going on? And so in this video I'm going to do a high-level overview of what's going on here. Why are they collapsing? Also, sort of what's their business model for both of them, Upstart and SOFI, and what do I think about it from here? What's sort of the potential from here, particularly focusing on Upstart following their first quarter earnings update. And if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. And so, as we look at these two different plays, Upstart, SOFI, they do have some similarities. It's all about using artificial intelligence to make new products, to effectively enable better, cheaper lending. For Upstart, you're talking about primarily personal loans and auto refinances. With SOFI, primarily student refinances. That's where they started, and they've moved into personal. However, they're having this aim of being an everything financial app, so you can do trading and everything. But at the end of the day, really what you're talking about with both of these businesses is using artificial intelligence to beat out the existing competition to write better loans, write more loans in these different spaces. And so far, I would say based on the data that Upstart is providing, it looks like their algorithms are better than the market. And, it looks like here it is. They talk about their annualized default rates as of March 2022, comparing it against, let's say, traditional FICO scores. And so you can see traditional FICO scores and what the average default rate is. And they're saying, well, wait a second, this FICO score doesn't factor in all the data we're able to use with our machine learning models. And we can split up these individual FICO scores where, let's say, the average, a 660 to 679 might have a 5%, default rate on average. They can actually split this, parse this into different tiers and say, you know what, we actually think that there's a tier within this FICO score that really defaults at less than 1%. And you need to be able to think about this better. The FICO score isn't good enough. We have a better model. And their data suggests that. The data suggests, yeah, we're able to partition out this risk better than traditional models. And if they're indeed able to do this, they are looking at a huge monster industries, whether or not it's personal loans, which is the smaller of the different ones that they're looking at, but still 100 billion plus market, auto 700 billion, and mortgage ultimately 4.5 trillion. So they're ultimately looking at long-term $6 trillion of annual loan origination that they're looking to disrupt. And you can see, yes, their product, when you're looking at Upstart, has gotten market share. They have been able to grow significantly over time. And this is by partnering. The way this model works is they partner primarily with various different lenders, credit unions, saying, hey, we have this algorithm that you don't have. So how about you use this algorithm and we effectively get a cut whenever there's a new loan. So whenever this loan effectively goes through, you pay us some sort of fee or commission for enabling this transaction, enabling these volumes. And so a lot of this is a dependency-driven model with various different financial counterparties saying, hey, do you have the balance sheet where you're eager to make these loans? Because we have the technology to help you figure out who the good credits are, who are the good counterparties that you should be lending to. And so this model has worked recently, up 156% revenue growth in the first quarter. You see their profit, real profit, income from operations up 124%, 35 million in profit during the quarter, net income around 33 million. So this is arguably, you're looking at Upstart and you're saying, yeah, they've delivered real results, amazing hyper growth, and they've sort of proven out their business model, saying, yeah, this can be a very lucrative business model. Now, this is in contrast to SOFI, which is sort of scrambling to try to do everything, a financial app, trading, investing, ETF products, home loans, personal loans, student refis. And so you're looking at all these different things. It's very much the same in terms of using, hey, can we use artificial intelligence to make better and cheaper loans? But the reality is SOFI is very far from profitable. They need to prove out their profitability in contrast to a company like Upstart. And so the challenge ultimately with these businesses right now, and this is the major concern that shareholders face, is you look at in-period defaults versus modeled by quarter. And this is a new chart that management's showing for Upstart saying, hey, you know what? This government stimulus led to a temporary overperformance, which reverted abruptly in the fourth quarter. So what's this mean? Hey, we modeled defaults would perform very well. And you know what? It actually performed greater than 40% better than we expected because of the government stimulus, where people could pay down their personal loans. And yeah, our models were here. Government stimulus led to much better results, much lower defaults, 40% lower defaults. But they're saying, oh yeah, recently things have been resetting. And this raises the question of like, well, wait a second. If things were 40% better in the past, is it possible you could have something where it's 20, 30, 40, 50% worse in the future? And so here it is, management's talking about the changing economic environment, where they talk about it became apparent that 2022 is shaping up to be a challenging one for the economy and for financial services in particular, talking about clear signs of inflation, how interest rates are moving up. The 2-year note has risen more than 200 basis points since October. I mean, this is a really important point. The financial industry effectively is leveraged to treasury yield. So as interest rates move higher, this is a direct cost of business. This is increasing friction for effectively the wheels of capitalism. And as you apply more friction to capitalism and to all this debt that the U.S. has, that will have a very clear impact on the economy. It might not be immediate, but it will sort of flow through to the economy over time. And you can't have an economy that's over 100% indebted like the U.S. economy and have a move in interest rates of 1% to 2% in fairly short order without an impact on the economy. So this is the early warning signs to investors saying, hey, folks, we're starting to see red flags with the economy. Wake up. You're either in a recession or facing an imminent recession. That's sort of like the warning signs that you're seeing. They talk about challenging economy. That's code for potential recession. They talk about lending is a cyclical industry. Once again, code for recession, always will be. We expect volume and pricing in our platform to vary. Increased risk in the economy as well as the corresponding higher returns demanded by banks and credit investors. The average loan pricing on our platform has increased by more than 300 basis points since October. This is the key point I was just saying. As U.S. Treasury rates moved higher, their personal loans needed to more than compensate potential investors. And this creates this sort of friction, this sort of dynamic where investors say, well, wait a second, if I can get 2% more from that risk-free treasury, why would I want to move up that sort of speculative risk curve with personal loans or with these auto refi loans? And so these partners, these traditional partners for Upstart are sort of saying like, I'm not so sure I want to do this. I'm not so sure I'm as eager to be in the marketplace for these loans. And so that's part of the concern that you're seeing. And they talk about how given the hawkish signals from the Fed, we anticipate prices will move even higher later this year. That's more friction for the economy, which will have the effect of reducing our transaction volume, all else being equal. So it's harder to write more personal loans, the more expensive it gets. Now, this has resulted in them cutting their guidance. Now, they're still expecting fantastic growth in fiscal 2022, but it's a lot lower than what they previously were expecting. Still expecting hyper growth is what they're saying. But, Wall Street's are saying, I'm skeptical. Your things are changing. The economy can change a lot faster than you'd expect. And you're also seeing them arguably take on more risk, which, I think some investors get nervous about because ideally this is supposed to be an asset-light business model where you're partnering with these credit unions, partnering with various different banks saying, hey, we have the algorithm, you have the capital, let's work together and you give us effectively a cut when you effectively feel like making a loan, and we'll show you, hey, these are better than the FICO scores. We can parse it up between the A and the F credits, and so that way you can get better default scores, better default rates than what you could traditionally measure using the legacy model. So there is still this potential for revolutionizing credit. So I agree with that aspect. The challenge is that when interest rates move higher, and let's say you're also facing a weakening economy, partly because interest rates are moving higher, is that appetite for risk still there? And so how is Upstart reacting to that? Well, they're taking on more risk. They're saying, additionally, we have started to selectively use our capital as a funding buffer for core personal loans in periods of interest rate fluctuation where the market clearing price is in flux, i.e. we're putting these balances, these loans, on our personal balance sheet. Notes and residuals at the end of the quarter was consequently up $604 million from $261 million in the fourth quarter. So this is a big deal. This is saying, hey, when times start getting volatile, we're going to start putting these loans on our balance sheet. This is more risk because if those loans start defaulting, that's a direct impact on their business. So this beautiful sort of capital light model turns into a capital intensive, much riskier model once things start freezing up. And that is part of the reason why arguably you're seeing Upstart stock down so significantly right now. And that's also, I've called these risks out before in my prior videos on both Upstart and SOFI, saying, hey, at the end of the day, what's your competitive advantage versus all these different banks that have deposits in their bank where they're like, yeah, we have these low cost deposits. It's easy for us to make the loan. We don't have to partner with somebody else and worry about the fickleness of their counterparty. And so here it is, this model, which is contingent on transaction volumes, now they're moving it onto their own balance sheet, taking that risk. Now we'll see how long they take that risk, if it's just temporarily, a temporary factor, but arguably this is more of a risky model. And so while SOFI still needs to prove their core business model and profitability, and I won't turn constructive on SOFI until I start seeing real profitability, Upstart does have profitability. They have sort of proven, yeah, this can be a lucrative business model. So what will it take for me to want to own Upstart stock, UPST stock, from here? First, a quick plug where if you're either struggling with this current investment environment where you're just trying to protect your savings, or if you want to find potential multi-baggers, the types of stocks that could potentially go up hundreds or even thousands of % over time, consider going out to unrivaledinvesting.com. It's the Unrivaled Investing subscribers that keep this channel going. So a big thank you to all those Unrivaled Investing Premium subscribers. And so let's dive into what would it take for me to get more constructive on Upstart, say, hey, I want to be buying Upstart. And so looking at it, yes, management is right. They are tapping into this huge industry. They talk about $6 trillion in annual originations, and they talk about being on a clear path to building a company with more than $10 billion in revenue. So they're saying, yeah, we think we can 10x from here. We're guiding to over $1 billion in revenue. We think we can easily, there's this clear path for us to do it. The challenge that I face as an investor is that I want to sort of see proven business models and want to see, hey, can you handle a full cycle? What happens if credit markets freeze? And that's my concern here is you had this period where saying, yeah, our models did way better than expected, but that was because of government stimulus. What happens if you have a period where effectively credit freezes over? And that's a huge concern because for the better part of the last few decades, the Federal Reserve was always there to step in and say, hey, yeah, the Federal Reserve, oh yeah, bazooka capital, billions of dollars of quantitative easing, we'll lower interest rates, whatever it takes. What if because interest rates, inflation is so high, the Fed is not there to step up? And you have a prolonged period, maybe 6 months, maybe a year, maybe a few years, where the capital markets have higher friction, and you don't have the easy ability to say, hey, we're going to make these personal loans and then we're going to go sell them to these credit unions, or we're going to go sell them. What if the different counterparties don't step up? And that's the big part that I don't have a good enough understanding. And if you're a mega bull on Upstart and you have a strong perspective on why the credit markets, one, won't freeze because the Fed isn't there, and two, how they will perform when arguably you see this, and this suggests, yeah, their default rates were 40% better than they expected because government stimulus. Why can't it be 40% worse than they expected? And could this be devastating, especially as they take some of this risk and move it onto their balance sheet? And you saw that once again this past quarter where they took, effectively put $200 million net, around $200 million went into their balance sheet, effectively saying, yeah, we're bumping up our loans amount that we hold to transact, to keep our business model flowing, which is based on transaction volumes. We're going to put it on our own balance sheet. But the question is, well, how long can you do that? So in the last quarter, it was around 200 million, but they have around 757 million in cash. So you could do this for another quarter or two, but then it starts running into problems. And that gets back to my point of, if you have a period of prolonged credit freeze, will this be a real problem for Upstart and SOFI, which is a very similar business model of sort of offloading that risk to counterparties? These models are contingent on having lots of transaction volume, saying, hey, we're going to write the loans, we're going to originate the loans, and then we're going to get some sort of cut when we sell them, when we distribute it to these other folks that are going to keep it on their balance sheet. What happens when that's not possible? And I'm not sure. That's the part that makes this really tough for me. And also, you see the stock market freaking out with Upstart saying, well, wait a second, you only have a couple more quarters where you could pull this off. What happens in that environment where you're not able to pull this off? And also, if personal loans start defaulting and you have them on your balance sheet, won't that result in dramatic losses? Another aspect that I think would make me more comfortable looking at a company like Upstart is seeing, yeah, the CEO isn't selling tens of millions of dollars of stock as the stock price comes down. If you were to see, Upstart CEO say, oh yeah, I have such confidence in our models and the default rates that even though we're potentially heading into recession, I'm no longer selling tens of millions of stock like he was doing just last month. Here it is. It's going, hey, we're moving from selling stock to, I have such high conviction that even though the stock's down, I'm going to be plowing it back into stock. Like that sort of buy-in, that would get me more interested. That said, long term, I do think these models using artificial intelligence can result in better loan originations. The challenge is that they are competing against other lenders that have strategic advantages over them. Like a company like Wells Fargo, I don't own, but there's a reason why Warren Buffett has owned the major banks like Bank of America and Wells Fargo over time, is because they have a low cost deposit base. They don't have to worry about counterparties for making loans. They can make those loans with their low cost deposit base. And so for something like Upstart or SOFI, you're going to be scrambling to figure out, oh man, the credit markets are potentially freezing up as interest rates move higher. What happens from here? How does our business model survive? Do we either A, face a huge drop in transaction volume, or B, do we put those loans, those risky loans, on our personal balance sheet and take that risk? And personally, that's not something I want to get in the business of. I'd rather have that capital light model that's just incredibly lucrative over time, that's not taking that sort of credit risk. So this is, at this point, this is too hard for me. I still don't see why either Upstart or SOFI is unrivaled. I see why they have potentially an unrivaled origination aspect where it's easier for them to make better and cheaper loans, but in terms of how does the rest of that ecosystem work in terms of distributing those loans, that's a little bit tougher for me to solve. If you have a different view, I totally welcome it. I'd love to hear it in the comments below. And if you enjoyed this video, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.